Welcome back to Fast Market. I'm Tom White, joined on set again by Scott Bauer, CEO of Prosper Trading Academy, and Steve Rashis, Chief Options Strategist at M1 Capital Management. All right, guys, we've got a weakening overall market here. Scott, your take on should we expect that going into, what do you tell your clients on a day like this where it's the last trading day of the year? We've had additional volatility in this overall market. What do you tell your clients?
So when I left my office to come over here this morning, literally I said to them three things. One, don't believe what you see right now.
Yeah.
Okay. Two, be careful of the width, the spread of stocks and options today, because as the day progresses, things are going to widen out. Be very, very careful. And three, watch the VIX. When the VIX was trading down around 26-ish this morning, I said to them, let's take a look here. This might be a buy point, because just because we got a tweet about, potential, talks with China, we've been there, we've done that, we've seen that before. So, I don't think that anybody wants to go into a non-trading day being long. I really don't.
Yeah, there's a lot of uncertainty in the overall market. To Scott's point here, Steve, and as an investor that hasn't been through this additional volatility for an extended period of time, we've had the VIX up, all month, and then throughout the month of October. So a lot of people haven't seen this extended period of time for higher volatility. What do you tell some of your investors or people that that, because you've been doing this for years and years trading? So what do you tell people?
Well, from a firm perspective, we're medium to long-term investors, and basically, a big part of the component of what we do is building a portfolio, hopefully at the best multiple levels we can. So this is a good environment for that. In addition, we add an option overlay strategy, which basically we sell premium and add short option deltas to balance out the overall risk of the portfolio.
Maybe the longs that you have in your portfolio.
Exactly. So this is a good environment for what we do overall as a firm. So to be fair, most of the conversations I have with our clients are more focused on, reallocating or thinking about reallocating between fixed income and, either adding risk or taking risk off depending on their circumstances. Most of our clients are not traders. Some are, so we have a handful that, we talk about, the different trading perspectives. So to be fair, I don't want to seem happy about this, but this is a good environment for our business, for what we do, for what our clients, for what we do for our clients. As a trader, this is gravy. I mean, this is beautiful. You can fade the moves, which is important. Option premiums especially are elevated, so you can stretch your win ranges, pretty significantly in terms of what you normally could have done in 2017. So this is, to me, a good environment.
Yeah, I think it is. If you believe in the economy, it's a great long-term time frame to get into the market. But at the same time, if you're just a trader, or maybe you want to hedge some of your existing portfolio or positions, this is a great environment to do it using that higher volatility that we always talk about, that inflated volatility. But I wanted to move this over to a macro, basically, level about the overall market, Scott, and that's the SPX. Now, but I think what we want to do is kind of create a couple strategies based on an assumption on whether things are going to stay the same, bullish, bearish. Your thoughts on the SPX and what you would do in this type of environment where the volatility is elevated in the overall market?
It's absolutely elevated across the board. Now, what would I do, again, as a trader or an investor? As a trader today, I'm on the sidelines the rest of the day today. I'm going to wait to see what happens coming in Wednesday morning. Now, if this were Wednesday morning, I would look to be selling premium, as we've talked about quite often. Now, I would have a little long delta bias to that, quite frankly. So I would look to probably sell an iron condor, which we've discussed before, which is the combination of selling a downside put spread and upside call spread. But I would do that with the put spread being a little bit closer to being at the money. So I can get a little extra protection to the upside. Meaning I'm slightly neutral to bullish going out the next 2-3 weeks.
Yeah, I'm going to kind of, we kind of want to look at something like this to Scott's trade idea or example here, Steve, by skewing this to the upside. So typically when we're selling an iron condor, and Ryan can follow us to the trading platform here, typically it's a neutral strategy, right? You don't have a bias whether it goes up or down, but you want good, positive probabilities of success. You want to collect a lot of credit because you're selling it out of the money put spread, not in money call spread, collecting premium. You want time decay or theta to work in your favor. Now, typically we look at probabilities out of the money, especially with an index like the SPX. I'll look at 75% as a put vertical that I would sell, and that would probably be down here at the 23.75. Now, to Scott's theory here, if he wants to skew it to the upside a little bit, how far would you go up on a probability of out of the money on a short put vertical and then match it up with a call vertical?
Well, I think the first thing, I might move that up to a 35 delta, maybe a 40 delta, because again, like, the nature of the way the SPX moves, I mean, we could be moving in 100-point clips here relatively easily. So I think that for a bullish stance position, I would tend to probably do a 35 to a 36 delta put as my short.
Okay. So we've got that up here right now, the 24.40. I'll sell that. Now this one's pretty aggressive on the downside, but you're collecting a $1.45 credit for that put vertical. It's $5 wide.
Yeah.
But your probabilities are a little bit lower as your delta, and I'll go ahead and bring that up again. Your delta is only about 35 on your short strike, but you need the S&P 500 to remain above 2440 at expiration in the next 17 days.
Yeah, no, I totally agree. I mean, and the thing is, like, to be fair, if you choose a 35 delta or a 25 delta, if the markets go into more turbulence, it's not going to matter because the down moves are going to be so abrupt. It's not. They're both kind of very difficult to defend. Right. So if you want a bullish position, like to me, like you could even go to the 2450, 2440, and make it a little bit wider. Okay. Collect a bigger credit. Now I know you're doing one lots in here, so it depends on your normal position sizing. But let's say your normal position sizing was 2 or 4, then you could do a wider put spread and do 1 or 2.
Right. Cut down your size.
Cut down your size a little bit.
You still have the same amount of monetary risk on that trade.
Yeah, totally correct. Yeah. So I mean, like that's how I see it. When you get into true volatile periods like this, the strike prices almost kind of become irrelevant. So I would rather, if I'm going to put on a bullish position, I would rather put one on that has the potential to make more money. Right. And you're either going to be right or you're not going to be right.
But the trade-offs on that are that they're going to be closer to the money.
They're going to be closer to the money.
Points are going to be
no
closer.
Question. Right? No question.
So now let's go up to the upside, Scott, because we've created that 35 delta is what Steve picked on the downside. Now, typically we'll go out to that 75% of finishing out of the money on the upside, but you wanted to go farther because you wanted to, extend this to the upside. Now, what type of probability out of the money or delta would you use to the upside to sell a call vertical above the market to create the short iron condor?
Yeah, I'd probably go to about a 20 delta.
Okay.
Okay, which the difference, quite frankly, with the way that volatility is right now, the premium collected is not going to be that different between the 25 and the 20 delta call spread, okay? Or the 25 and the 20 delta call. So I'd rather have a little bit of extra room, take in just a smidgen less of credit. But overall here, Tom, if you put this up here and let's say we sell the
2600, which is
2605.
Yeah, okay.
Okay. So you put that up here now. I love this thing. I've got a $5 wide iron condor. Max this can ever go to, whether the S&Ps go down to 2300 or up to 2700. I've now collected more than 1-to-1.
Right.
Better than 50-50. Yes, my downside risk is a little bit more than my upside, but I'm intentionally positioning myself for that. Yeah.
So
love that setup.
You guys make a good point with the fact that an iron condor is a neutral strategy, right? But you can skew this thing to be to match your assumption, whether it's bullish or bearish. If you were more bearish that the market's going to be under some more pain, you could sell a call spread that's closer and go wider down the put spread. But let's go ahead and analyze this. Go ahead, Scott.
One more point I was going to make. If we do get a move to the upside, and that's the unknown, but if we get a move to the upside, that call spread to the upside is really actually going to start collapsing unless that move is all at once.
Well, now
unless we get an 80 handle move.
Now tell us why, because if the underlying is going up towards our short call vertical, shouldn't that make it expand? But
except for the fact that on the upside we're going to see volatility contract.
Right.
We will see volatility come in.
And that helps a short iron condor.
It helps a short position.
So
not necessarily short delta, but short premium position.
Yeah. So what we're gonna do is, and we've created that trade here. We've got it up on the Analyze tab here. We'll get some of these things here. But I kind of wanted to just bring up the break-even points. And Scott makes a good point with the fact that you're collecting about 1-to-1 on this particular iron condor skewed to the upside. You got the current index trading, towards the short put vertical, but this is an assumption to the upside. Steve, 1-to-1 on a short iron condor position as far as risk reward is pretty good, isn't it?
Absolutely. No, totally. I think this is a terrific construct for a bullish position. I would throw one other addition to this, because in really high volatile periods, especially when you trade the big index products, you should look at some of the long butterfly positions at strike prices much higher, because what happens when vol explodes like this, those butterfly prices collectively really collapse. So if you're going to add an additional bullish play, you could say to yourself, well, what happens if we start to move above 2,600 here?
Right.
So what I would do is go a little bit farther out, maybe even 45 to 50 days.
Okay.
Look at the I mean, I'll just wing it, the 2600, 2640, 2680 call butterfly. Like something that is a true explosion. So you're talking about a 40-point wide butterfly that you could probably buy for a relatively cheap amount of money.
Right.
Add that to the position. So that way, if the market does take off, volatility is going to collapse. That butterfly is going to expand in price.
And you're working against the credit that you take on the short iron condor,
Correct.
but also, Scott, it protects you to the upside a little bit more.
Yeah.
It gives you a little bit more bump there
does.
too.
Yeah, take a look at what, I mean, I don't know if you could pull it up.
Yeah, we've only got a minute here, but we're going to go ahead and take a look at that.
Sorry.
Moving forward,
I don't
maybe
want to
I'll
push you too far.
No, maybe we'll hit on that on Wednesday, see what
Sure.
the market does.
Sure.
But that's a great analysis of how to maybe overlay
Right.
an existing position that
Yep.
you have, maybe for an assumption that you might go higher on.
Yeah.
That. All right, I'd like to thank Scott Bauer, CEO of Prosper Trading Academy, and Steve Rashis. What are you, Managing Director of M1 Capital Partners, right?
Yes, you can call me whatever you want.
I'll call you Steve.
You can call me Steve, that's fine.
I'd like to wish you guys a happy new year and all the best in 2019. That does it for Fast Market. Tune in tomorrow at 10, or tune in Wednesday at 10 a.m. Central Time right here on the TD Ameritrade Network. Have a great day, everybody.